Hello everyone. This week we will review some CPA prep contents on derivative and hedge accounting. If you see the CPA material, this module, they focused on four different aspects of derivative and hedge accounting. In first part, they talked about different concepts, terminologies, and definitions, and then later, in second part, they gave some examples of common derivatives and a little bit new thing you will learn about derivative risks that we didn't learn much in our textbook chapter. These all are conceptual. And then in the third part, you will see the accounting part, and we will learn different type of accounting impacts, specifically how these derivative instrument would impact on balance sheet and income statement, whether you need to report any gain or losses, and where you have to report those in income statement or under the stockholders equity part as other comprehensive income. And then you will also see at the end how the derivative instruments will impact on the cash flows. So let's start with our first part, where we are talking about different definitions and concepts related to derivative and hedge accounting. For the definitions and concept part, first they talk about derivative instrument, and the concept is pretty much same what you learned in your textbook chapter. A derivative instrument is a financial instrument that derives its value from the value of some other items or some other instruments, and it also explains the same criteria that US GAAP mentioned. You also learned it. Then it talk about underlying. So underlying is a specified price, rate, or other variables. It could be interest rate or any security, stock, commodity price, foreign exchange rate, etc. And then it talked about the notional amount. So notional amount is a specified unit of measure. So you can measure the notional amount in terms of number of shares. For example, a call option, how many shares you will purchase, or for a commodity, number of pounds or bushels, or it could be also in currency unit. Then it talked about the value or settlement amount. So for derivative, we need to come up at the end with a settlement. The value or settlement amount of a derivative is the amount determined by the multiplication of the notional amount and the underlyings. Right. For example, if you would like to come up with some settlement amount for a call option, of course, you need to see the price differences and how many shares you have as notional amount, and of course the stock price is your underlying. And then payment provision. For payment provision, this is the provision which is specified at the beginning of the derivative contract. It's a fixed, or it could be determinable based on the settlement that is to be made if the underlying behaves in a specific way. And then the last concept we also learned from the textbook, and it also discussed a little bit specifically the cash flow hedging and fair value hedging. So hedging is a special kind of derivative that is used to offset any anticipated loss or any negative outcome, or to reduce any earning volatility. So this is all about the definitions, and then later they discuss about some examples of common derivatives that firms can invest in. There are four major derivatives that they discussed. One is option contract, then future contract, forward contract, and swap contract. So for option contracts, you already know that there are two parties involved, and one party gets the right or the option to buy, and another party will have that to sell. So there could be two types of options. One is the call option, which gives you the right to buy. Another is the put option, which will give you the right to sell. And remember that option contract or options are the right, and it's optional, it's not an obligation. On the other hand, if you look at futures and forward contracts and also swap contracts, those are obligations. You have to do it. For a future contract, this is an agreement between two parties where the parties will exchange any commodity or currency or any other asset at a specified date on a specific future date. And here one party will take a long position. Long position means the party agrees to buy. On the other hand, the other party will take a short position. Short position means the other party will sell. So long means you will buy and short means you will sell. Remember, future contracts are obligations. If you are in the contract, you have to do your part, no matter you make a gain or loss. And here, one information or criteria you can remember, future contracts are made through a clearing house. On the other hand, if you are in a forward contract, so the forward contract you will do with the assistance of an intermediary rather through a clearing house. And then you have swap contract. For swap contracts, you have two parties, and here they usually will do the contract through an intermediary and they exchange future cash payments. And one common example, you will see interest rate swap, that one party could do fixed rate, another party could do agree to pay in a variable rate. And you saw the example, or it could be currency swap, it could be equity or commodity swap, but interest rate swaps and currency swaps are very, very common. And then we will learn about the derivative risk. There are two types of risks involved in a derivative contract. One is the market risk. Market risk is the risk that you may face a loss on the derivative contract because of the movement of the price of a stock, or the changes in the price of the commodity, or the fluctuations of interest rate or currency exchange rate. This is because of the market factors. Those other underlying factors are changing and you are making the loss. So remember, for those derivatives, it's always a zero-sum game. That means if one party makes a gain, the other party will make a loss. So market risks are related to those market factors. On the other hand, credit risk means that your counterparty may not fulfill the contract at the end and may not pay you back. Either the other party could be default or any other reason may be involved, and because of that, the other party will not perform according to the contract. That will create your credit risk. And then here you will see some accounting part, how the contracts will impact on your financial statements. And of course, for financial statements, we always know the balance sheet and income statement, and we have a little about the statement of cash flow. Remember, whenever you invest or purchase any derivatives that will be on your balance sheet, it will be either as an asset or liabilities, depending on the rights or obligations under the contract. And we also know that all derivatives must be measured at fair values. And here, if you have any changes in the derivatives, you also need to report gain or losses. But the question is where you will report those gain or losses. There are two places you can show those gain or losses. It could be any realized, and most of the case when you are just holding the instruments, derivative instruments, it would be unrealized holding gain or losses. So you could report it in your income statement, or you could report it under the stockholders equity part in your balance sheet. So here, this part, reporting gain or loss, will talk about all those spaces and places where you have to report those gain or loss. So for reporting gain or losses, the CPA book actually used this table. This table is really very beautiful and summarized everything. So remember, there are different reasons why a company invests in derivative. So if the reason is not to hedge, remember, no hedging, just to invest some money in call or put options in anticipation of increasing the stock price, going up or down, and this is how the company can make money. So if the purpose is not to hedge or to reduce some negative outcome or to protect some future loss, we call it its no hedge designation. And if you have any gain or losses, you have to show it in your income statement. And you will see the common example is the unrealized holding gain or loss from an option, and we have to show it in our income statement. It's part of your income. For here, hedging, there are two types of hedges, fair value hedge and cash flow hedge. So for fair value hedge, this type of hedging is to reduce your risk or the risk of loss, and the risk may arise as a reason for a change in fair values. For example, you are holding some inventory and the inventory value may go down, and that's why you are hedging just to protect the future loss and negative outcome. Now, when you will make a loss from inventory value, losing the inventory value, on the other hand you will make a gain from your fair value hedge, and both will offset each other, and that's the purpose of hedging. Now if you have fair value hedge, again you have to report those in your income statement. It's just an income item. On the other hand, if you have a cash flow hedge, then you have to initially report it under the stockholders equity part as OCI, other comprehensive income, until the hedge transaction impacts on your earnings. So if you remember one example from your textbook, you anticipates that the raw material price will go up, and that's why you do hedging. And this hedging, even if the price goes up, the hedging will help you to make a gain and protect and reduce or offset that losses. So since here you may face a loss because of change in cash flow, for example, if the raw material value goes up, you have to pay more cash to buy those raw materials. So that's why it's called cash flow hedging. And here this cash flow hedging will help you to reduce that future losses. So initially we will record it under the stockholders equity part, and later when we will see that you purchased the raw materials even though you paid higher price, but your cash flow hedging helped you to make some gain and to offset that loss. And then when you will sell, you will manufacture and produce your goods and sell those goods, and you have to report cost of goods sold. You need to do the adjustments, and this is how, when the hedge transaction impacts on your cost of goods sold, we need to reclassify it and we have to show it as an income part. The same thing may happen for foreign currency hedge, although we didn't see an example. But remember, for foreign currency hedge, there might be three types of hedging. One is fair value hedge, another is cash flow hedge, another is net investment hedge. For fair value hedge, if you have any gain or loss, you have to include it in your income statement. On the other hand, for cash flow hedge, you have to initially include it under the stockholders equity part as other comprehensive income, and then when the hedged item impacts on your earnings and offsets your losses, then you have to reclassify and show it in your income statement. On the other hand, net investment hedge, you will include it in other comprehensive income as cumulative transaction adjustments. And then you know how you have to report the impact of any derivative contract on your statement of cash flows. Right, so here for statement of cash flow, one example is call option. So we settle the call options, and then we see that we come up with some cash exchange with the party who sold the options, or our counterparty. Now for this, we do not physically trade or exchange shares. That means we don't buy shares and then sell shares. Rather, we come up with some settlement and we make some cash and we report it based on that. This is how your financial derivative can impact on your financial statement on different part, from balance sheet, income statement, or stockholders equity part, and your cash flow. Now we'll see one quick example from the CPA prep material on derivatives. The question is, a derivative designated as a fair value hedge must be, there are two criteria and you have to pick. Number one, specifically identified to the hedged assets, liabilities, or unrecognized firm commitment, and expected to be highly effective in offsetting changes in the fair value of the hedged item. So both criteria are right. So your answer is both 1 and 2, right? So why do you do fair value hedge? Because you do fair value hedge, you expect that it's very highly effective in offsetting in your changes in the fair value from the hedged item. And of course, it's specifically identified to the hedged assets and liabilities. Now, if you remember the fair value hedge example that you learned from the textbook, for example, you are holding some inventory and the inventory value may go down, so you are also using one hedged asset, so that those are highly effective, and even if your inventory value goes down, that hedged asset will help you to offset that value you are losing. So this is how we use fair value hedge, and both are the criteria for fair value hedge.